and welcome to the NC podcast. My name is Natasha Collins and I am the host and founder of NC Real Estate, which includes its members club for landlords and property investors to come and build profitable property portfolios that completely align with their goals. As well as that, I have other programs and other services that I think you're going to want to go and check out on my brand new website. Guys, I've spent months overhauling this. So go to ncrealestate.co.uk to find out more. Today, I am super excited to welcome Tony Wallace onto the podcast. Tony has over 15 years industry experience, is currently the head of lettings and property management at Rooney Auctioneers, very good with property investment strategy and all things property management. And we know each other because Tony lectures at UCEM. We're going to be working together on the undergraduate property management modules for any of you that potentially listening and coming on that this semester. Tony also lectures at Cork College of Commerce and Technological University Dublin on topics such as valuations and property management. Tony also helped develop and lectures on the Residential Landlord and Tenant course run by the Irish Property Owners Association. Hi, Tony.
Hi, how are you?
Good, thank you. How are you?
I'm great. Delighted to be here. Delighted to be on this podcast.
So excited to have you. You're a man after my own heart with your finger in so many pies. I think that's the way of the property industry nowadays, right? You get involved with everything. Absolutely.
But the beauty about property, as I'm sure you can appreciate, is there's just more than one thing. When it comes to property, it's not just sales, there's lettings, there's management, there's investments, there's valuing the investment, asset managing it. So if I do more or just one thing, I get bored. But property allows my adventurous personality go off into various different areas. So I enjoy all those different pies that we mentioned.
I completely agree with you. So let me ask then, how did you get to where you are today? Because you've had a varied career. So tell me, in a brief summary, how did you get to where you are right now?
You'll know why I'm actually bald if you can see it once I get to the end of this brief description. When I was quite young, when I was in school, I was absolutely obsessed with property. Why there was different types of property, what it was used for, where it was located, why it was located, etc., etc. And I got work experience when I was in school, and when I was in the work experience, I just fell in love with the lifestyle, and it was without question, this is what I want to do for the rest of my life. That decision was made at like 14 years of age, a bit older now. So unfortunately, in the Leaving Cert, as we call it here in Ireland, or GCSEs in the UK, I didn't get enough points to get into the real estate course full time. So I dyed my hair back to its natural color. I took my earring out and I borrowed money to buy a suit, and I knocked in every single surveyor's door, and I said I'd work for free. Just let me in the door. I'm hungry for this. And that happened. And I got in the door of an agent here in Limerick, worked there full time for 6 months, and also continued to work part-time to pay my way. Then one of the bigger property managers in town opened up their own firm, took me on, paid for my exams in Dublin, and gave me my first salary. Spent the first 7 years with that firm in exclusively property management. But of course, as you said, I get very adventurous, and I wanted to know everything about property, the whole circle, from start to finish. So I went about continuing on in my education. I moved to various locations within the island of Ireland. I got involved in auction sales, private treaty sales, also while with property management, and also continues to be very interested in what drives value and how do you come up with opinion of value and so on and so forth. I'm very intrigued by that. Continue to educate, and then eventually I was hired by a firm who showed me the valuation way of life, while managing a portfolio. And that's really a short synopsis of my industry experience. And because I was so interested and pretty much glued to any kind of education offering that was available, I find myself now giving back, which I really enjoy, to the future property managers, future valuers, through the various locations, as you mentioned at the top of your podcast. So I find myself in full-time industry and part-time education as a result, and it helps. Recently engaged and bought a house and doing it up, so it helps to pay for all that.
Yes, definitely. And it's amazing how people fall into the industry. Everybody has their own individual stories, which I find so much more interesting than the typical like standard career path. So thank you for sharing that. Essentially, guys, take the message away that if you want to get into property, you can be here. So let me ask about, how have you seen the market changing in Ireland? Is the local market in Limerick doing well? How about compared to the rest of the Irish market? What's going on at the moment?
Well, it's an interesting trend when you look back at just kind of Ireland as a whole for the last, I'd say, let's go back to 2006, 2007, when it was very much viewed, and we didn't realize it at the time, but it was very much viewed that values were at its height, or at the height they possibly could go. But what we didn't understand at the time, and I think this is fair to say about a lot of real estate markets throughout the world, it was a false economy where the houses prices were fueled by large amounts of debt, or people acquiring debt who really couldn't afford to pay back that debt. And an example of that is an investor who has their own home but is investing at getting 100 and 110% mortgage to buy an investment property, and the extra 10% for furniture, because it was seen as that your property will go up in value in the next 6 months, don't worry about that 10%. Absolute lunacy when I think back on it, right? Lunacy, but that was the reality of it. And then when the market started to dip, and then the banks and the issues with the banks and lending, so on and so forth, started to unfold. It got worse and worse and worse. The demand went down and down and down, and down goes the prices. Large, I think it was something like 30% of the stock in Ireland was vacant from 2012 to 2014. But then all of a sudden things started to recover. What was recovering was we kept our graduates. More multinational companies were setting up camp in Ireland. Facebook, Google were expanding, Pfizer, we have Regeneron, large Apple are here as well. Large multinational companies expanding and staying in Ireland because they enjoy our demographic. We're educated, predominantly we're living and working in, if not the capital, regional cities. We're well connected, good broadband, but also have good links into Europe and English speaking as well, which helps these American companies. So they started to grow. The population started to grow as a result, and the demand for property started to increase. But our stock, our housing supply, our commercial property, they just stopped building during the recessionary years. So then we had this imbalance of supply and demand, and on came on our housing crisis. And there's been various things that have been put in place to try and stop the capital appreciation or the rate of appreciation, like the designation of rent pressure zones being one of them. But a capital appreciation on investment properties have continued to grow. Mm-hmm. And I would feel that it's going to continue to grow at a modest rate because the lending is still there. Now, we're no longer at 110% mortgage rate. We're now at 70%. Which I think is more realistic, and the cost of finance is somewhat more viable. But so it's continuing to head in the right direction. And often the question comes then is, well, what did COVID do? And in reality, at the time of this broadcast, COVID has absolutely had no impact on the residential market. We'll talk about other areas in a moment on the residential market because mortgage repayments are subsidized, tenants' wages are subsidized, and also rents themselves are subsidized. So we're held, we're protected, we're protected if you want. If the minute that protection unravels and the amount of jobs we have go back to reduces, then we will see a retraction in the market, I would feel. But what I've seen happen is these large companies that we so rely upon for employment and so on and so forth aren't packing up their bags, aren't leaving as they once did in 2007, 2008, are in actual fact adjusting to the COVID world that we now live in. Jobs are being kept. It's just how we work has changed. Now, in terms of retail is very, very, very hardly hit at the moment for obvious reasons in terms of trying to physically go out and shop. But what we noticed is the demand for office space, which would have been around, on average, 100 square meters. They're no longer interested in the 100 square meters. They want 250, 300 square meters of office space because they want their staff in there to allow for the 2-meter distancing, etc., etc. Sorry, I should say that office space prior to now, they would have been operating out of home or in a small office. Now they need bigger space, on comes the demand. But likewise, warehousing. I've seen, like for argument's sake, I know it's a very controversial thing to say at the moment, but unfortunately Debenhams have gone into liquidation, as we know. But Debenhams are still operating online. They have an online platform, and therefore they need a warehouse to hold their stock so they can sell their stock. And an awful lot of companies are like that. I call it the Argos model, which has been here for years, but is only kind of coming to fruition now with other companies. So to answer your question, the real estate market in Ireland as a whole seems to be holding its own. I expect modest increases with the exception of retail, which I think will retract back.
Okay. Is there dread over Brexit? Because I have been reading, I keep abreast of this because I think it's important. It's the one thing that seemingly slipped under the radar in England, and people need to be talking about it more because I think it's going to have an effect. Do you think there's dread over Brexit in the local market, or do you think this will help bolster the market?
In terms of the real estate market? In
terms of the real estate market, yeah.
It's I think there was a funny statistic that came up that the applications for Irish passports kind of doubled overnight. once it was clear that Britain were leaving and the UK were leaving the EU bloc, and we're like, yeah, sure, no problem, come on in, no problem, sit down, I'll boil the kettle, there's no problem. There's a strong there's not really concern in terms of Brexit. What I mean by that is when Brexit was first spoken about, and then when the systems were put in place, we saw, and this is more Dublin based, we saw a renewed interest in office space, grade A office space in the capital or any area within the regional cities, within the motorway, from companies who are predominantly based in the UK, that their clients and they're feeding into Europe. And unfortunately, without that easy access into Europe, they saw great value in locating to Dublin or to Galway, Limerick, Cork, because they'll still be operating in the EU market. Now, what has that done? Effectively, I think it was in 2018, from an office point of view, effectively, it was kind of discussed that from an office accommodation point of view, we're full. We can't take any more. We'd love to have it. And that influx came in when Brexit, when the bill went passed through Parliament. And
wow.
Yeah, it was, so it's kind of there's a positivity. Now, bearing in mind, from an Irish point of view, there's the free movement of people that exist. That treaty was agreed in the 70s and renewed between Theresa May and Simon Coveney 2 years ago, where essentially both Irish and British citizens can live and work in each other's countries, obviously within reason. So there's not this kind of scare, or we're not scared of it. It's, in actual fact, it's had multinational companies look at Ireland who have never would have looked at Ireland before.
Yeah, amazing. Okay, so it's positive. That's good, because it's not all that positive depending on who I speak to. So that's good to hear. So let's talk valuations. These are
just before we move off, can I just say, Britain, okay, we don't want to lose Britain out of the European bloc, and if it happens, no problem at all. But can we have John Burke out? Can we keep him in the divorce? I love that man, and if he's listening to this podcast, please get in touch. I'd love to buy that chap a coffee. He's just, oh yeah, I can't get enough of that, you know.
You need him as part of your trade deal.
Yeah, no, I want him. Bring him over here. Him and his funky ties as well. You know, really, I know the man is brilliant, and I really like his honesty and opinions, and I'll be buying his book, that's for sure. But yeah, so you know, Britain, leave Europe. Okay, fine. I'm going to miss you, but can we have John Burke out in the divorce, please?
What a request. Maybe he can be your Speaker of the House.
Oh, yes, of course, of course. Now, my fiance or my wife-to-be will have something to say on that.
So let's talk valuations. They are always a contentious issue. You are somewhat of a valuations expert, and I mean, valuations is something that I always say on this podcast. I don't go as far as valuations. So I'm going to ask you, where do you start with a valuation in residential property compared to commercial property?
I suppose it's a funny kind of aspect. I suppose the biggest difference I find in residential versus commercial is actually emotion, where a residential investor is almost motivated and fueled by emotion and pride, while a commercial investor will be more strategic and fact-based and researching and finding, etc., etc. Now, that's a very general statement to make. I know there's various, not all investors are like that, but I do find that when it comes to valuing residential property, you got to take your emotion out of it. I lived up the road. I know someone that used to live next door, etc., etc. You got to step away from that and then look at the trends surrounding that property. Mm-hmm. And as you've often spoken about, Natasha, comparable evidence, which is huge, right? Huge. But it's not, to me, it's not good enough to just see what next door sold for. That's your price. Fantastic. So therefore, the price of the subject property is X. To me, that's a really flawed and amateurish, right? What really and truly, I prefer to not just find 3 comparable evidence, but also maybe find 5, see a common trend, and also build up a good relationship with the sales agent, because the sales agent will tell you, yeah, you know what, that went too high because there was a vetted interest there. It went bidding because 2 neighbours wanted it. So it went high and high and high. Therefore, the price that was achieved was a bit inflated. Or it could be the opposite. We should have got more, but we weren't on the market long enough. But if you look at your comparable evidence and analyse your trend, I would think it will tell you an awful lot. Often I find the biggest mistake people make is, oh, should the one around the corner sold for whatever, 200,000 euros, pounds. Therefore, mine is worth 250,000 because I have nicer curtains. You know, this type of mentality. It's to analyze the comparable evidence and recognize the trend, and then adopt your own opinion based on your findings.
Mm-hmm. Okay. And so, with commercial, then, how does that differ?
Commercial is, I suppose, residential is predominantly comparable evidence. Commercial is, there's 5 ways to value a commercial property, and I would love to go through the 5 different ways in detail, but you told me you only have me for so many minutes, so we're not going to do that now. that's a whole different, you know what, that's a whole different academic term is what that is. But how does it differ? It differs in terms of what's been generated out of the building, what's the rental income coming out of it, how strong is that income, how strong is that person, that company paying that income. Is, for argument's sake, is the hotel making money? Is it run too well? Is it not run well enough? Is a restaurant or a bar, is it meeting certain criteria? When you remove a very efficient director from running a good company, well, how efficient is it then? Will that affect the value of it? Is there goodwill involved? Nursing homes are very intriguing to me as well. Again, all around profitability. But it goes a commercial point of view. To me, it's stats and facts. It's rental income, it's profitability, and also the yield that's applied to those figures.
That's a good way of distinguishing between it. How have you seen valuations change over the last couple of months? Have you seen any difference?
Well, in terms of when you say valuations, as in the value of property over the last couple of months, or?
Yeah, with all of the big changes in the world with COVID, how have you seen that change in any way, or?
Do you know, it's very funny. We were locked down. Not that COVID is funny. That's not what I mean. The lockdown came in March, and essentially we weren't allowed to open our offices to the public until June the 2nd. And at that time, the morning, I think it must have been 5 or 6 phone calls I got from clients saying, "Oh, right, I've money in my account. I want to invest. Is there good value for property going?" You know, it created this. Well, I suppose what's important to remember is that during the lockdown, we're still in jobs. You know, our wages are subsidised. Should there be an issue? Money is still there. We cannot actively spend our money. So the confidence and the want to invest in property didn't go away during COVID. In actual fact, the pent up interest just grew. And it was like, I want to invest now, you know. So when the door opened, the phone rang, and it created this bit of a surge. Now, there is this confidence has slightly been removed in terms of who knows what COVID will bring. My response to COVID is absolutely devastating to the world. Of course it is. But it will come and go. A vaccine will be found. We will move on. It will be something we will tell our children and grandchildren about. Mm-hmm. But it hasn't solved our housing crisis, nor has it got rid of the appetite for commercial investors. So in the 6 months that we were in lockdown, I would have said values held their own, and I think they would have slightly increased from then to now. Maybe 1-2%.
Mm-hmm. So what would you advise any current investor to look for when buying property in today's market? Do you think that would have changed since before COVID? How should an investor look at and approach the market?
Again, take emotion out of it. I have come across clients time and time again that bought property for the sake of having property. And to me, that's a big issue. That's a big problem, because you can buy bad property too. Mm-hmm. And I've found that, especially in the recessionary years, that when you bought bad and have borrowed heavily on a bad property, located property, should I say, it's the first to fall in the recession, very difficult to fill or to rent, and the last to recover. So, point one, location. And there's no getting around that. Your warehouse should be within a motorway network. Your office should be in a strong demographic area where there's high education, good broadband. Your residential property should be where people want to live. Your retail should have high footfall levels, you know, large window display units. It should have a cluster, so on and so forth. Think of the end user and how suitable your property is to that end user. Very simplistic approach. You've often spoken about yields, Natasha, and rates of return, so on and so forth. And that is very important. But first and foremost, location, and think of your end user. There's no sense in buying a warehouse in the middle of a residential estate. And you'd be surprised for want of a better word, ignorance or pride that fuels investors to say, well, I have a portfolio of property, but if it's not making money for you, it's not worth a damn.
No, definitely not. And do you think that because Lenders and valuers do look at demand and how quickly a property will let and what it will be bringing in. Do you think going forward that's going to be more at the top of the agenda and affect the loan to value and interest rates?
Certainly. I mean, what I often find, and it has been happening, COVID or no COVID, is that generally the lender and the investor will talk, and amongst the two of them, they will say, well, if you can get a tenant that will pay X amount of rent, we'll lend you the money. That X amount of rent then is decided between the banker and the investor, and then you go to the valuer, and the valuer says, no, that's not quite realistic. It all falls apart very quickly, and that's the one thing that the recession has been very good for, is to get rid of that kind of perception of, sure, any tenant will pay anything, and if you can put it down in writing, fantastic. Now here's $1 million, or treat yourself. Sorry, I've lost the question. Can you repeat the question again?
Yes. So do we think that the demand is going to have more of an impact on loan to value and interest rates than it has done previously? Because usually it's just comparable rents, look at where the market is, look at what the local valuer is. But do you think that there's going to be more of a spread of risk from lenders who are looking at different types of property and they're saying, well, hold on a minute, no one's coming to take that property from you? Hell no.
You know, I'd like to think so. I'm not convinced that that's the way. I do like to think so. Like, you know, I understand the method the banks take in terms of your interest rate is based on the risk that the bank will take in investing in your property, so on and so forth. I don't see that level, that way of thinking going into investing. It's more on the lines of, I want a property and I want to go buy it. There is various, I suppose the loan to value needs to be at 70% for commercial, and I believe it can be as high as 80% in certain circumstances in residential. It's that element there, as opposed to interest rates. It's that element, that loan to value. I think that will change based on the risk, and I would encourage any investor to have that loan to value as low as absolutely possible. Because remember, I suppose, something in paper in terms of getting borrowings, generating rent, you got to pay back the bank. Debt doesn't come for free, and it doesn't come cheap. So I would spread risk in terms of your portfolio diversity through warehousing, retail, office, residential, etc., but also take baby steps in terms of if you're going to the bank looking for 70%, well, maybe think in the next 12 months, can you save up and then go to the bank for 50%? Because that 20% saving on debt that you borrow could save you hundreds of thousands. Do I see banks taking the same mentality? No, I think if they meet certain criteria and tick the boxes, they'll give out the money. But I would encourage investors to do your research on how much debt actually costs.
Mm-hmm. That's a really, really good point. Or at the very least, start paying it down pretty quickly to just try and alleviate against the increase in interest.
Because like when the market hits, like, we go in circles, in real estate circles. So if you find yourself at high interest levels and high amounts of debt, and your loan to value is perceived to be 70%, and then you go and try and sell it, and you realize, well, maybe it's closer to 95%. That's where it comes. That's when the chickens come home to roost.
I just thought of another question I wanted to ask you about, because there is so much scaremongering in the property market. I don't know if you get it in your local papers, but across social media, which has run riot through the industry over the last couple of months. It's now a lot of scaremongering about the fact that property prices are too high, next year property prices are going to be low, all of this kind of crystal ball looking at the world and people getting just in their heads about it. What would you say to that? What would you say to people who listen to sources that they've never verified? What would you say about how should you conduct yourself in the market?
I think you've hit the nail on the head in terms of verify the sources, because there's a bucket load of information out there that you can accept to be the truth. But in reality, is it? Like, I often see statistics on, like our version, Right Moves and the Dipla, Zoopla. Our answer to that is daft.ie and myhome.ie. And the publications that come from those websites will suggest that prices are going up, down, left, right, whatever the case may be. But they're not, the data they're going off of is asking prices. Asking prices are fueled by vendors' expectations. They don't reflect the end price. The end price will appear on what we have our regulator called the Property Services Regulator Authority. They publish a price which clearly states what an office rented for, what a warehouse rented for retail, and also what a residential property sold for. So that verification is very, very important. Also, listen, I suppose, think about the person you're listening to. What qualifies them to tell you that it's a bad time to invest? It's a good time to invest. What have they done? What education have they got? Are they an economist? Have they invested in property themselves? To me, and I'd love to know your view on this, Natasha, but to me is, if you want legitimate property prices, or sorry, property advice, should I say, and I mean legitimate property price, go to a property manager or go to a valuer. Why I say that is a valuer is constantly researching and reporting on market conditions and formulating an opinion on value based on tangible evidence, and they're formulating that opinion with the knowledge that they will be audited or regulated and have to stand over those words for better or for worse, right? So their opinion, they need to have it backed up. A property manager is living and breathing, working with tenants and landlords every day, for better or for worse. So my view is that if you want property advice, talk to your property manager, talk to your valuer. There you'll get a factual report of what's going on. But I'd love your view on it.
I completely agree. And people who are in the market all of the time, because the one thing that people won't speak to valuers is because they don't want to pay money for advice, which it really gets my goat, because if you want to know the exact situation of the market, you go find the valuer who specializes in that area and you ask them. But again, phone up local agents, find out what they've got to say, and then do your due diligence. My gosh, like, you have to be so on the ball with what values are. And last week on the podcast, I was talking about the fact that where I invest in property in Bath, earlier on this year, I bought property for £260,000. The property opposite has come on the market, same size flat, top floor walk up, come on the market at 395. And I was joking about how either I've made a lot of money, or they just, they've decided where the market is. But that's not necessarily fact. And if I got that agent to come and value mine, that's not necessarily fact either. I would need to ask the local valuers, and probably the valuer who came and valued mine would have a very good understanding of where the prices were. But again, you're right, like local experts who are on the ground, and we all have our subject specific areas that we're very good at and we're very knowledgeable at, but it's the people who actively take the time to follow the market, the people who are going to have the information for you. Not anybody who's just, watching national trends, because that doesn't mean anything.
Yeah, and to compare and contrast, we will, no problem in the world, hire a building surveyor to issue a report on the structure of the property, because we don't want to buy a property that doesn't have a good structure, because it's going to be costly. And no problem at all will think twice about paying that surveyor for that report, because we see that, if the house or the building is falling down, there's no sense in buying it. Sometimes you have to spend this money to find out that this purchase is not right for you. And as you often say, Natasha, your investment goals.
Exactly. Okay, final question. How do you see the property market changing over the coming 12 months?
I mean, the funny thing is, like, if we get a vaccine, I see an acceleration on capital appreciation. If we don't get a vaccine, I see a suppressed appreciation. And I use the word appreciation for a reason. As I say, the multinational companies that we so rely upon in this country for employment are not leaving, are not packing their bags and going home. They have adapted their workforce to work around COVID. Our housing crisis in this country has not been resolved, and looks like, reading up into planning policy, and I've attended serious political meetings on it, it looks like it won't be resolved anytime soon. So, but unfortunately, because of COVID, there is a slight bit of confidence that has been removed from the market. So I think the rate of appreciation will be modest once the vaccine is available to us. That capital appreciation, or that rate of appreciation, I feel will speed up.
Okay, amazing. Fingers crossed for a vaccine.
Absolutely. We'll be talking in 12 months, and the property market will have gone off the cliff, and you're like, Tony, what were you talking about?
Oh, I hope not. I really hope not.
No, I really don't think it will be, because, as I say, multinational companies, the jobs are still there. They're still there to go back to, and if you're not working in an office, you're working from home, or you're split between both. So I would see that trend continue.
Okay. Tony, this has been fabulous. Thank you for coming on my podcast today. I really, really appreciate it. For everybody who's listening, if you've loved this podcast, please leave a review and make sure that you share it. Leave a comment, tell us how you found it, and make sure that you come back and listen again every single Tuesday. Thank you for listening to us today. I cannot wait to catch up with you again soon.